I am Ryan O'Dowd of the Black Hand Communique. Today's episode is called No Finance Romance. God damn it. No Finance Romance. Kopsick on Alternatives to Finance. Now, as many of you know, finance determines much of what happens in the world today. Not only people, but businesses and even governments are dependent upon it. In many ways, finance is even more powerful than the state itself. It determines wars, manufactures crashes, and generally keeps the little guy playing the game. Like the rules of the classic board game Monopoly explain, everyone gets paid by the bank. The bank owns all the properties, and if the bank runs out of money, it just makes more paper. On this week's episode, Joe Kopsick, say hi, Joe.
Hi,
Say it again. I didn't click it right.
everyone.
All right. Is going to break down some of the nuances of capital, explain some alternatives to finance capital, and focus especially on cooperative credit unions as a particularly viable alternative. So that is enough of me blabbing. Joe, you have the floor.
All right, well, first of all, I'm going to explain the problem, which is cartelization in banking. There's been a dramatic decline in the number of major banks over the last 10 years. We may remember a chart from 2009 published on motherjones.com showing how 28 banks were taken over by other banks and merged with one another to form the four major banks we know today: Citigroup, JP Morgan Chase, Bank of America, and Wells Fargo. The next biggest banks after that are Goldman Sachs and Morgan Stanley. And in 2008,
Hey, let me jump in here. Those don't happen to be like 6 of the top 10 donors to Hillary Clinton, are they? Because I think they pretty much are.
yeah, Goldman Sachs was her number one. I think they probably gave a lot to Obama too. I could be wrong on that.
Yeah, I recall that in the 2009 election, both Obama and John McCain got over $1 million donated to them by Goldman Sachs. Thought that was pretty interesting. Back to you.
Hillary's got her front for Goldman Sachs because 9/11.
We'll get into that another time.
So in 2008, the top four banks held 43% of the GDP, equivalent to $6.4 trillion. And today they hold nearly $8 trillion, which is nearly half of the GDP. And in 2013, the 10 largest banks held 54% of the GDP, compared to only 20% in 1990. Since 1985, the number of commercial banks with branches in the U.S. declined from 6,000 to 5,500. And in that time, the number of single office banks declined from 7,000 to just 1,000.
Now, sorry, jumping in here. Just to elucidate on this point, they're not declining in number because they're going out of business. They're declining in number because they're being bought off by bigger banks and merging, correct?
Right.
Right.
And I should just distinction, the stats I just gave, 6,000, 5,500, 7,000, 1,000, that was commercial banks. And before that, I was talking about investment banks. And there's a separation, but there's really not. But that's what this whole video is going to be about.
Mm-hmm.
So one of the
teaser.
One of the causes of cartelization is the mergers which have been allowed to take place. First, when there was a signal that Citigroup would not face prosecution for becoming a conglomerate, and accelerating following the deregulation of the securities market with the repeal of Glass-Steagall and its replacement by the Gramm-Leach-Bliley Act. And I'm going to discuss three major pieces of financial legislation: Glass-Steagall, Gramm-Leach-Bliley, and Dodd-Frank and its component, the Volcker Rule. So Glass-Steagall is called the Banking Act of 1933, passed under FDR right at the beginning of his administration, passed after the stock market crash that led to the Great Depression. And in 1929, the stock market crashed, thousands of banks failed, public trust in the system collapsed, and bank runs were common. And so the primary function of Glass-Steagall was to break up the banks and erect a regulatory separation, commonly called a wall, between commercial banks and investment banks, commercial banks being involved in traditional banking, and investment banks involved in higher risk investing activities. So the point was to limit commercial bank securities activities and affiliations between commercial banks and securities firms. And another purpose was to limit speculation and make banks safer repositories for public money, and to protect people's bank accounts from risky investments. It's all just different ways of phrasing the same thing.
Right. So So let me jump in. So in other words, the idea was to keep that the banks that basically hold the public's money, as in just average people's bank accounts, were in theory supposed to be separate from the banks that were operating kind of like venture capital, where they take higher risks and they try to invest in order to make bigger gains and stuff like that.
Yeah,
Correct?
yeah.
Okay.
The point of Glass-Steagall is to separate commercial banking, investment banking, and securities. The point being that one bank should not be able to simultaneously practice both kinds of banking. So commercial banking is what normal consumers do every day, using a debit card, opening a savings account, and getting a loan for a house or small business. And investment banking refers to what we see in corporate America and Wall Street. It's when banks help facilitate a big business deal, and it's inherently riskier than commercial banking. And during the Great Depression, many people believe that failures in investment banking spread to commercial banking, therefore hurt regular people, leading to bankruptcy and loss of jobs. So the FDIC was set up to have the federal government back deposits in commercial banks and stop people's deposits from being used to finance the riskier activities of investment banks, and also to regulate the amount of risks that commercial banks are allowed to take with government guaranteed deposits.
Yeah. So if I can just jump in right here, I think that the general idea behind this is pretty simple. Most people don't like play the stock market so much unless you count their 401k. They don't try to be activist investors and take over companies like that movie Wall Street. They don't do any of these big business deals that a major corporation is going to end up doing, like mergers and ruthless acquisitions and all that. Most people use banks mostly because they basically have to in our society, because if you don't have a bank account, you can't get your paycheck cashed, unless you want to go down to the payday loan place, which is even more vicious in the way, not that it takes out than a normal bank would be. But the problem with this is, if I can be so bold, that the banks back then, before the Roaring Twenties, and again in the 2000s, used ordinary people's bank accounts basically as collateral for themselves to bet in the stock market on risky derivatives. And without getting into what that is, basically they used your money, you out there, as their collateral so that they could gamble your money, and then they lost their money and your money in the 30s and in the 2008 crash. It's more technical than that. I'll let Joe get into the details. I just wanted to paint broad strokes. All right, go ahead, Joe.
So Glass-Steagall, the restrictions kept banks and bank deposits at a safe distance from the markets, but that distance gradually shrank. And in the free market days of the late 1990s, Glass-Steagall was formally revoked. So Wall Street pushed for the repeal of Glass-Steagall beginning in the 1990s. Their arguments were that the regulation was too strict and it didn't really protect regular people from risky behavior on Wall Street. And also the rule put them at a disadvantage over European competitors who are not under the same restrictions. So the banks said that the market, in conjunction with regulatory restrictions, would be sufficient to limit the amount of risk commercial banks. And even after the repeal of Glass-Steagall, banks were supposed to keep commercial and investment funds separate, but the regulation was not easy to enforce. So the main problems during that crisis that didn't involve banks. Excuse me.
Oh, you're fine.
All right. So the problems were primarily at traditional investment banks, and had Glass-Steagall remained in place, this is what Wall Street's arguing. The financial crisis would almost surely have happened anyway if Glass-Steagall had stayed in place, because, and this is what Hillary Clinton argues, and I'll get into more detail on that later, which is that different banks besides the four major banks, like things that aren't technically banks, were also a source of the problem. But it's been argued that since those major banks gave lines of credit to those non-bank entities that are more or less actually involved in the same kind of banking that the big banks are doing, securities, investment, but also brokerage. I kind of lost where I was going there. But
Yeah.
Still is what Wall Street and Hillary Clinton argues.
Right. Let me respond to that real quick. Number one, as you said, the big banks extended the lines of credit to the smaller, like credit card companies and non-traditional finance companies themselves. But even more than this, the big banks themselves, when they mixed themselves with investment banking, didn't just the idea that okay, let me break this down a little for myself easier. Yes, it's possible that the crash in 2008 would have happened even if the investment banks weren't connected to commercial banks because they might have been stupid enough to make the mortgage derivatives a bet in the first place. But if they weren't connected, then everybody's bank accounts wouldn't have been used as collateral for those more risky financial decisions. And there's a good argument that the reason Hillary Clinton and the big banks are saying this bullshit is because it's a very technical argument, and they're assuming the ordinary person isn't going to have the patience to get into the fine details of it. But the fact remains, without all of those people's savings accounts as collateral, and you could argue, because I know you're a libertarian, without the FDIC guarantee of $125,000 for each person, which also is a form of artificial kind of risk-rewarding legislation, without the ordinary people's bank accounts, they probably wouldn't have made the really, really, really risky bets because the only money they would have had to be able to use as collateral is their own money. But you see, they were able to use other people's money, your money, and that's probably why they made the risky bets, because they suffered less from the crash than you did. Especially the banks that survived the crash, they're perfectly fine, even though people's mortgages and houses were wiped out across the United States. So, please continue, Joe.
So, and to build on that, not only did the investment banks have access to the money in people's commercial bank accounts that's insured by taxpayers, they also got bailed out by the taxpayers, I guess, through different money. So,
yeah, so they got bailed out by tax dollars after their savings account was collateralized to make the risks that crashed it in the first place. Yeah, that's pretty much what happened.
So in 1998, before Glass-Steagall was repealed, Citigroup became a conglomerate combining banking, securities, and insurance services. It was formed through mergers out of Citicorp, Citibank, Smith Barney, Primerica, and Travelers, and received a temporary waiver from the Federal Reserve, even though it was in violation of both Glass-Steagall and also Bank Holding Company Act of 1956. So even though it was in violation of these laws, it received a waiver from the Federal Reserve, probably because they knew that soon after Glass-Steagall would be repealed. And so in November 1999, Bill Clinton signed the Gramm-Leach-Bliley Act to replace Glass-Steagall because he was facing veto-proof majority. The Republicans were in charge of Congress. So let's see. Gramm, Leach, and Bliley. The act was really called the Financial Services Modernization Act of 1999, and also known by a few other names. And it tore down the wall between commercial and investment banking after a decade of increasing financial industry deregulation, and paved the way for the creation of banking behemoths such as the four big banks that I mentioned. The purpose of Gramm-Leach-Bliley was to enhance competition in the financial services industry by providing a prudential framework for the affiliation of banks, securities firms, and other financial service providers. It repealed part of Glass-Steagall, removing barriers in the market among banking, security, and insurance companies, and barriers that prohibited any one institution from acting as any combination, or its employees, officers, or directors acting as employees, officers, or directors of any member bank.
Okay, what was the name of that legislation one more time?
Gramm-Leach-Bliley.
Yeah, and then the irony of this is they argued that it would make the industry more competitive, but as soon as they deregulated it, they just, as Joe said, started a series of mergers, making the market less competitive. because you have less big players in the market overall, which means you have more of a tendency towards price control. And clearly, if one is getting politicians to sign this legislation in the first place, there's some corruption and double dealing going on already. The SEC, who's supposed to be there regulating the banks, is looking the other way. So clearly, there's some kind of triangle of corruption. And it only got less competitive and more corrupt, ironically, since they were arguing it was going to do the opposite.
Right. I wouldn't be surprised if some of those major banks weren't big contributors to Clinton's campaign or to the campaigns of the Republicans he was facing.
So Probably, yes.
Clinton expressed some regret that happened, and it's, he says he faced a veto-proof majority, but I've also read that, he says he struck a deal with Republican Senator Phil Gramm to repeal Glass-Steagall altogether, so he might have just kind of wanted to.
Yeah, plus he was well known as a guy that changed his policies a lot as he went along. He was that kind of politician. He's happy to be a chameleon, That was what he was known for, so.
Yeah, he was known for the word is triangulation, like
yes.
He knew Republicans were, and he tried to govern from the middle.
Yeah.
So later on under the Obama administration, Obama asked Congress to bar banks from proprietary trading, which is the buying and selling of securities for their own account, particularly subprime mortgages packaged as bonds. According to former SEC Chairman William Donaldson, if banks were underwriting a corporate stock offering and had trouble getting rid of the stock, they would buy it with people's deposits, sometimes taken without the depositor's knowledge.
Yeah.
Sometimes it's best to explain something as a joke. And Brian Regan's recent special, he tells a story about a friend explaining the mortgage meltdown to him. His friend says, "You have a mortgage, right? Right. You pay your mortgage to the bank, right? Right. They bundle those with other risky securities and sell those to speculators, right?" And he says, "I feel like someone's explaining a magic trick to me. I put my quarter in my hand, right? I put your quarter in my hand, right? And I close it, right? It's gone." Well, I ain't got a quarter no more. Exactly.
Yeah.
So, move on to Dodd-Frank and the Volcker Rule. So, July 2010, Obama signs into law the Wall Street Reform and Consumer Protection Act, or Dodd-Frank, after Chris Dodd and Barney Frank, both Democratic senators. The aim of the bill was to promote the financial stability of the country by improving accountability and transparency in the financial system, end too big to fail, protect taxpayers by ending bailouts, and protect consumers from abusive financial services practices. And the bill aimed to create resolution authority, a way for regulators to safely wind down and liquidate a big bank that gets into trouble in order to avoid bailouts. It new restrictions on derivatives and called for public exchanges where derivatives would be traded, limited debt card fees, and tries to end too big to fail by imposing new regulations on banks with more than $50 billion in assets. Also called for up to 400 new regulations and created several new regulatory agencies such as the Bureau of Consumer Financial Protection, which is spearheaded by Elizabeth Warren. And you want to jump in?
Yeah. Well, yeah. How you know if that's actually working, or is that it's kind of like the repeal of Glass-Steagall, where that ends up being the opposite of what you want?
I don't really know if it's working. Elizabeth Warren claims it's working, but as far as I know, we still have those 4 giant banks.
And they could still invest in investment banking too, right?
Mm-hmm.
Yeah.
So as part of the Dodd-Frank Act, in July 2012, the Volcker Rule was enacted, named for Reagan-era Federal Reserve Chairman Paul Volcker, who proposed the legislation. It's been said Dodd-Frank never goes as far as Glass-Steagall did in separating commercial and investment banking, and the closest it gets is the Volcker Rule, which has been called Glass-Steagall in spirit, because it's different enough from Glass-Steagall to deserve its own name. The Volcker Rule prohibits banks from conducting certain investment activities with their own accounts and limits their ownership of and relationship with hedge funds and private equity funds, also called covered funds. It bans banks from risky speculative trading with federally insured money.
Yeah, federally insured. They can't trade with the government's money anymore. But I bet you anything they could still trade with people's private savings accounts or collateralize them.
Right. Yeah. I've so many things like credit default swaps and collateralized debt obligations. I just kind of just too many words.
Just glaze over. Yeah.
Search.
I get most of my information on all that stuff from Max Kaiser. I don't know if you ever watch him.
I thought you were going to mention him. I've only seen him a few times. He seems to know what he's talking about. But yeah, I don't have the patience for it. I learned a little bit in that Matt Damon narrated movie about Iceland. And
yeah, I remember that one. yeah, I remember that was a really good movie too. Yeah, Max Kaiser is kind of like half a comedian and half an old Wall Street guy. He definitely seems like if he's not bipolar, he's definitely using some kind of stimulant the whole entire time he's on the camera because he goes crazy sometimes. But I find him to be entertaining, at least as far as a financial journalist is concerned. Those aren't usually too exciting. But as far as the collateralized or uncollateralized debt swaps, it's basically very simple to explain if you take out all the legal terms and the technical terms. It's the mafia. The mafia gives you $20, and then in a week they say you owe them $50 back. And if you don't give them $50 back, they just put a gun to your head and say, fuck you, you have to give it back, or else I'll destroy you. That's basically how the global finance system works right now, because what it means when it says it's non-collateralized is it means that the huge banks themselves, they don't have to have collateral. They make credit out of thin air. And then they give that credit to you, then you have to have collateral. And if you don't give the money back with interest, then they'll take your collateral. So they make credit out of thin air, and then they take shit back from you that you actually have to work for. So that's the basic, real fucking huge problem with the global finance system right now, which you could go deep into. But it's, I like to talk about Greece, and what just happened to Greece is just right like that. The European Central Bank, ECB, it's called the Troika. The ECB, the IMF, and the Bank of Berlin gave Greece a bunch of money to bail them out after the 2008 crash. They said, but it was a loan. It wasn't a gift. It wasn't we're paying you off. It has to be paid back. But it's ridiculous because how is a government that's already in default supposed to pay you back with interest when the bank is the only source of money? It doesn't make any sense. But then when
used to pay off the debt.
Yeah, they give them the debt to pay off debt, and then they say what's even worse is they make them have austerity, which means they cut all their government services while paying off the debt that they're paying with debt. Which of course, in the short term, you could argue whether cutting is good or bad, but in the short term, austerity always causes a contraction. It causes a shrinking in the economy. So they make them do austerity, give them money at interest, and then make them pay back at more than interest with the less of an economy they have from the austerity. So it's just a death spiral for like a country like Greece, or might be Portugal soon, or Italy. Greece is really suffering. And my favorite guy, Yanis Varoufakis, calls it extend and pretend. It's like they just keep giving them loans and then pretending that they're able to be paid back when it's just logically and economically completely unfeasible that's even possible to do that. But then what happens, I'll finish this up real quick. The ECB, the Troika, then say, okay, now you have to privatize your public assets, which in Greece is like, the Acropolis, the Parthenon, all these ancient sculptures and art and everything that they have from thousands and thousands of years ago. So what it amounts to is you have the Bank of Germany. Okay, first of all, what we're talking about throughout most of this is that the American banks crashed the world economy through mortgage derivatives, et cetera, et cetera, et cetera, et cetera. So American banks crashed the economy. Greece's economy defaults, and the government defaults. They were in the black, now they're in the red because the whole world went down. So then the European Central Bank gives them money and says, give me back more money next year while you cut your services. And then Greece says, next year, I can't pay you back because you made me cut. And all I have is the debt that you gave me. And so they're like, okay, we'll give you more debt. But this time, you have to underwrite the debt with your public assets. So now you have a German bank saying, next year, if you don't pay, Germany owns the Acropolis. Germany owns all the public art that you've had for 3,000 years or whatever. And it's just like the mafia, and that's what the real core of this is all about. Is it's just the mafia on a huge scale, where the mafia.
The Nazi art strike again.
Exactly. And the mafia just gives you $20, and then if you don't get them 50 in a week, they'll say, "We'll fucking kill you." That's all it is. All right, go ahead.
The mafia can break your legs, but this is just a fancy, civilized way of breaking your legs, where they take all your stuff and send you to debtor's prison where someone breaks your legs.
Yeah, and then you don't, and then what's left of your healthcare system is gone, so you can't pay for your legs to be fixed, et cetera, et cetera, et cetera.
So the next thing I'm going to talk about is opposition to Glass-Steagall's reinstatement, and that would be opposition by Wall Street apologists. They argue that Glass-Steagall wouldn't have prevented the 2008 crisis because the real culprits were non-banks like Lehman Brothers, Bear Stearns, and AIG. Lehman Brothers is a global financial services firm, and Bear Stearns is an investment bank and securities trading and brokerage firm. Robert Reich, Bill Clinton's Secretary of Labor and an economist, says they got their funding from the big banks in forms of lines of credit, mortgages, and repurchase agreements.
Yeah. Oh, you're going to love this too. I'll jump in for just a second. Yeah. When Greece joined the euro, it's been proven, Goldman Sachs falsified documents claiming what Greece was capable of economically to get them into the euro. So they lied, like, to the central government of Europe, and then Goldman Sachs is one of the banks responsible for crashing the world economy. And Greece is one of the countries that goes under, and of course they can't pay back. Whereas if Goldman Sachs just didn't lie about it in the first place, they wouldn't have been falsely put in, et cetera, et cetera, et cetera. So if you look deeply at all these things, you see there's a lot of these four banks, maybe a couple more banks are behind a whole lot of shit.
Mm-hmm. And so it's been said that Glass-Steagall is likely to become an important issue in the 2016 election. According to CNN last month, liberals and some conservatives have championed Glass-Steagall's reinstatement since its repeal and the 2008 market crash. So I'm going to talk about a few candidates' positions. Martin O'Malley says he supports passing Glass-Steagall type legislation and favors a modernized Glass-Steagall, saying his proposals go a lot further than Secretary Clinton's, saying that her closeness with big banks on Wall Street is sincere, heartfelt, long-established, well-known. Says that Clinton's comments on Glass-Steagall were disappointing, and that she's embracing the arguments pushed by the architects of deregulation that big banks did not play a major role in the financial crisis. It says we need a modernized Glass-Steagall. His campaign manager says we need a modernized Glass-Steagall to help reduce risk, the size of too big to fail banks, and reduce the chance of another financial collapse.
And then she says 9/11.
Yeah, right. Let's see. Rudy Giuliani said about Ron Paul, he said, I've heard some pretty absurd explanations for 9/11, and the fact that we've been bombing them is absurd to him. But I think Wall Street really takes the cake as far as absurd explanations for 9/11 goes.
Yeah. As far as reasons we don't want to regulate Wall Street, because those brave bankers and financiers were back there trading within the week or whatever.
Mm-hmm. Yeah, they rushed the cockpit, all right. So Bernie Sanders supports reinstating Glass-Steagall, and a few other notes. I don't have any details on that. I guess he just supports it. Totally. He also added, credit unions are the future of America, and he opposed the TARP bailout in October 2008, which is $700 billion.
Yeah, him and like three other people. Ron Paul being one of them, I believe.
Right. So, good segue. Rand Paul, he doesn't support reinstating Glass-Steagall, but instead he supports limiting FDIC deposit insurance, perhaps to $100,000 per account. That would be lowering it. And that's the same amount that Canada insures banks and credit union accounts for. And this is a good idea, at least as a goes for trying to satisfy conservatives because it avoids, putting a law back into place, and they want to have deregulation,
Yeah.
it's reinstating the law. And libertarians in general believe, although I'm not saying Rand Paul is a total libertarian, libertarians believe there should be no compulsory rules against companies being involved in multiple types of any kind of activity, including financial activity. So the libertarian solution would just be to allow investment banks to do whatever they want, but to just kind of have less insurance or not have any public insurance at all.
Well, yeah, and I think that if you build a system on the theory, then that could definitely make sense. Although I'm sure you would admit that the part of the reason that these huge investment banks and are willing to fuck with so many people's shit is because of state protection and state incentive to turn into a humongous international corporation. In fact, this is something not often talked about, but I was just talking with my sister yesterday, talking about the whole, what's it called? When you export, you offshore your taxes, right? So I don't know if these companies do this. I'm sure they do somewhat. But if you put, your tax haven in Mozambique or whatever, and then you only do business in America, then you don't pay any taxes, which is like a weird international incentive for foreign companies in general to go into people's home countries. So, if China doesn't, if China can offshore to, I don't know, if American companies offshore, then a Chinese company could come in because of the whole quote-unquote free trade agreements like NAFTA and FTAA and all that stuff. It actually provides a weird incentive for foreign firms in general to go into people's home countries and pay no taxes. So you kind of form this international out of corporations. Am I making sense when I say that?
Yeah, but it's a little hard to follow.
I don't think I'm explaining it well. Let me try again. If I'm an American business, let's say I'm Walmart, okay? Just for example. If I have my tax location, like my business is officially located in the United States of America, and I'm selling officially in the United States of America, then I owe taxes to the government of the United States of America. But if I'm Walmart and I make my business location legally to be Portugal, but I don't have any stores in Portugal, I only have stores in the United States of America and I sell in the United States of America, then I don't owe any taxes to Portugal or the United States of America because I'm not selling in Portugal and I'm not located in the United States of America. And so what these companies do is they offshore their taxes. From an economic perspective and from a libertarian perspective, this automatically provides an incentive for countries in the world that are in these free trade agreements where they don't pay what are they called, tariffs or anything. Well, then if I'm a Chinese company located in China, but I operate in America and sell in America, I'm not paying any taxes to China or America. So, and if I'm an American company located in America, but all my stores are in Germany, selling to Germany, hiring German workers, then I don't pay any taxes in America or in Germany. And so it incentivizes corporations to jump ship and go outside of their home country. So it forms like an international class, corporate class, that basically have no real, what's it called? No real attachment to any particular nation. Right. And they don't pay taxes anywhere. So it's like the people that are owning everything are also just kind of hovering above everyone else, never having to be responsible for taxation, or from a libertarian perspective, never ever competing on an equal ground, because the businesses in America that are operating in America have to pay taxes, but the businesses in America that are operating outside of America don't have to pay taxes. Now, is that a better way of explaining that?
Yeah, they're seeking tax havens, and aside from the world in general, like you can do this within the United States. You set up your corporation where corporate taxes are the lowest, and you set places where the sales taxes are lowest.
Exactly, and the whole world is getting to be in this place because there's an increase of these free trade agreements, so-called, which aren't free trade agreements from a libertarian perspective, because they use the state to incentivize foreign business over national business. So it's still not libertarian free trade.
Yeah, they're not getting rid of trade restrictions or tariffs or barriers. They're just lowering the limits.
Right.
Yeah, they're still, government's still taking taxes and imposing tariffs.
And even if there was no tariffs, our government would basically still be taking more taxes from American businesses than they would for the foreign businesses operating in America. That's how it's a weird form of international corporatism. I don't know. I'm just talking. Yeah. All right. Go ahead and go back to what you're talking about.
So Elizabeth Warren's next. She supports bringing back Glass-Steagall. She says if banks want to engage in high-risk trading, they can go for it, but they shouldn't be able to get access to insured deposits and put taxpayers on the hook. So she and John McCain and 2 other senators proposed reinstating Glass-Steagall over the last 2 years. They said we need to rein in too big to fail banks. We need to reinstate and strengthen the wall between insured commercial banks and investment banks in order to discourage the largest financial institutions from exploiting regulatory loopholes in order to take excessive risks at taxpayer expense. Warren said in an email, Wall Street spent decades and millions of dollars in order to repeal Glass-Steagall, and they'll do whatever it takes to keep it from being reinstated, and we should fight back to make our financial institutions smaller and safer. Mike Huckabee is the only active Republican candidate backing the restoration of Glass-Steagall. This is according to the website of Lyndon LaRouche, who ran for president back in the 60s. Mm-hmm. A weird mix of a communist and a FDR Democrat and a Hamiltonian Federalist, and he supports restoring Glass-Steagall. Joseph Stiglitz, an economist, said that commercial banks are not supposed to be high-risk ventures. They're supposed to manage other people's money very conservatively. He says it is only with this understanding that the government agrees to pick up the tab if they fail. Investment banks, on the other hand, have traditionally managed rich people's money, people who can take bigger risks for bigger returns. And when Glass-Steagall was repealed, it brought investment banks and commercial banks together. The investment bank culture came out on top. And New York University economist Lawrence White and also Hillary Clinton believe, as I mentioned before, that Glass-Steagall would not have prevented the risky activity that led to the crisis, which brings us to Hillary Clinton. She says she opposes reinstating Glass-Steagall. She says because she thinks it doesn't go far enough. She points to Lehman Brothers, AIG, and Bear Stearns, which are involved in, aside from investment activity and securities trading, also financial services and brokerage. So she regards them as non-banks, and that she thinks that's her reason for saying that it isn't just banks that cause the financial meltdown. She says she wants to go after what she thinks the real problems are, and she doesn't think that you can point to one piece of legislation saying and say if we just pass that, everything would be fine. She wants to include big insurance companies in addition to banks, and go after what's called the shadow banking system and hedge funds. But although she says that she doesn't want to bring back Glass-Steagall, one of her aides says nothing has been taken off the table.
Okay.
So many people blame the crisis on the removal of restrictions that Glass-Steagall has imposed on banks. Doesn't mean that ending Glass-Steagall was a good idea, so she's wrong and right at the same time. She said she went to Wall Street in December 2007 before the crash, saying, quit foreclosing on homes, quit engaging in speculative behaviors, and asked the bankers to voluntarily suspend foreclosures and freeze interest rates on adjustable subprime mortgages. Yeah. They didn't take steps, and she says that she would consider legislation to address the problem if they didn't take the steps she proposed. Also, she supported TARP, unlike Bernie Sanders and Ron Paul. She called for an end to the culture of recklessness and ideology of indifference in Wall Street and D.C., respectively.
Well, she's really good at saying things without doing anything, isn't she?
Yeah. In fact, she proposed 5 pieces of legislation having to do with mortgages and banking. Only one of them got any kind of success, but didn't get passed anyway. That was at the end of the Bush administration.
And how much do you want?
Both sides
How much?
of every.
Yeah, I say, how much do you want to bet she made a certain kind of bill for it to fail, just for her to say, "Oh, I tried," but she didn't actually want to succeed because she is deep in the pocket of Wall Street and the banking class in America.
For all we know, that legislation was written by regulators or people who are in or have been in the financial industry, and could have included all kinds of riders that guaranteed failure, or was too long for people to notice what was in it, bother to read it.
Right. Because she is very much a political animal.
Mm-hmm.
All right. On a tangential note, I'm gonna take my brief monologue here. On a tangential note, finance is deeply embedded on Wall Street. We were just talking about Wall Street. Now, the connections weaving from Wall Street to the City of London and Washington, D.C. form a veritable Gordian knot of undeserved power. Ooh, one person who cut his teeth on manipulating these connections is Donald Trump, who is coming to Raleigh on this Friday. For those of you who don't know, I live in Raleigh, North Carolina. This is the location of my music and my art. This is where my house is. I'm not going to give you my address. But Trump is coming to Raleigh on Friday, and I'll be quick about this because it seems like everyone's either on the hate Trump train or the love Trump train, and I really don't understand the love Trump train, people. And I am definitely on the hate Trump train, but I hate to be a purveyor of cliches. So I'll just be quick. I do think that Donald Trump is a complete fucking maniac, but I also think he is very cunning and very intentional. I think no one gets to his position in the finance and real estate industry without having a deep knowledge of how to manipulate people. And normally you'd say Donald Trump doesn't really apply in this conversation of alternatives to finance, but he is sort of on the edges of right in the middle of everything we're talking about, because he made his money by conning financial institutions into giving him loans so that he could buy real estate in New Jersey and Manhattan and Las Vegas, so that he could go so far into debt with the loans of others by collateralizing his casinos and his real estate that he was one of the inventors, basically, of Too Big to Fail. Now, legally, he never ran a Ponzi scheme, which is why he didn't go to prison. But he was very, very close to going to prison in the early 90s because he had every bank in America, including the ones that we've named today, eating out of his hand, and he was playing them off of each other so that he started with $1 million and ended up like a 3, 4, 5, 10, if you believe him, billionaire, solely as a real estate owner, in other words, a landlord, and a casino owner. Of course, those are his legal operations. It's been well respected and pretty much understood. He's got connections to the illicit underground side of organized crime, mafia, because you can't really be in the casino business without that. And someone's got to threaten these junior investment bankers when he makes too much money. So even though Donald Trump is not known as someone who fucked up in the mortgage crisis, he is a landlord in Manhattan, of all places. And even though he wasn't well known as someone who speculation caused the crash of 2008, he did run up so much debt to so many New York banks that he got them to underwrite his casino operations just so that they wouldn't go out of business, which is like a little version of what Lehman Brothers, AIG, Goldman Sachs, etc. did to the federal government. So I think to have this man as the president of the United States after the 2008 crisis is complete and total insanity. It makes no perspective from just a civics point of view. It definitely makes no perspective from a libertarian point of view, because the man is not a libertarian whatsoever. He's used force many times in his life in order to accomplish his ends, and he believes nothing in shrinking government at all. He's really a lightened, toned-down version of a fascist, which is someone who combines racist racism, militarism, and a strong government, central government with little social services, disrespect for the unionization of ordinary people, and a general belief in a strongman concept where one guy solves everything, and democracy or liberty or property is nothing compared to this one man. So that's my statement on Donald Trump, who's coming to Raleigh on Friday. I'm going to appear there and gently protest. I don't plan on getting arrested because I have a show the next day, but I'll wear a Donald Trump t-shirt. So now I'll be getting back to Joe to continue talking about finance and its alternatives. Joe, you have the floor.
All right, and I'll just say about Donald Trump, that is really the ultimate Ponzi scheme. He gets $1 million loan from his father, just one person in the beginning of his life. Then at the end of his life, he gets all the power and money of 310 million people, and probably be pardoned or whatever, not face any charges for whatever he manages to get done. Hopefully,
man,
can get in. So I'm going to go into credit unions and how they're a solution to all this. So what they are, credit unions are democratically controlled, member-owned financial cooperatives. They differ from banks in that they elect their boards of directors in a one-person, one-vote manner, regardless of the amount invested by the number of people. They have no source of secondary investment capital, which means that credit union investors buy securities directly from the company issuing them, rather than the investors trading securities among themselves. In the U.S., they're tax exempt, but only from federal and state income taxes. They do have to pay payroll, sales, and property taxes. And only if they operate, they're only tax exempt to that extent if they operate and are incorporated under state credit union laws. Members themselves pay income tax and dividends earned through participation in the credit union. And many S corporation banks, which are closely held corporate banks choosing to be taxed, enjoy the same taxation structure. Federal credit unions operate in accordance with the Federal Credit Unions Act. If they do so, they're considered entities of the U.S. government and are also tax exempt. To review, that's federal credit unions. Credit unions are not for profit, but not necessarily non-profit. Unlike charities, they do not rely on donations. They must make a small profit or surplus to cover their expenses, and their revenues from loans and investments must exceed their operating expenses and dividends, which is interest paid on deposits, in order to maintain capital and solvency and remain in existence. Some history: the first modern credit unions date back to the mid-19th century in Germany, and credit unions came to North America in the early 1900s. The banking industry has been opposed to and intense relations with credit unions since their establishment in the U.S. Banks argue that credit unions' tax-exempt status gives them a competitive advantage. Banks and bank trade associations have fought for anti-credit union legislation. Credit unions in the U.S. peaked in 1969. In the U.S., all federal credit unions and almost all state credit unions have deposit insurance of at least $250,000, just like regular bank deposits, commercial bank deposits. The NCUA, the National Credit Union Association, insures those deposits. State chartered credit unions are not required to obtain deposit insurance, while federal credit unions are. Before the financial crisis hit, the FDIC insured about 8 times as much money in deposits compared to the National Credit Union Share Insurance Funds. So that's the FDIC compared to credit unions. In the U.S., credit unions serve 100 million people, and their assets reached $1 trillion as of 3 years ago, and directly employed almost 250,000 people. Largest credit union in the country as of 4 years ago was the Navy Federal Credit Union, which serves employees of the Department of Defense and their families. Credit unions also manage the funds of labor union members, many different labor unions. Credit unions weathered the 2008 financial meltdown reasonably well due to their small size and limited exposure to mortgage securitizations. In early 2009, the federal government's NCUA took over 2 of the country's biggest corporate credit unions. As of 2010, there are 53,000 credit unions in 100 countries. Countries with the most credit unions activity are the US, India, and Canada. And there's also a lot in Ireland and the Caribbean and Central American countries. The purpose of credit unions is to promote thrift, provide credit at competitive rates, provide financial services, support community development or sustainable international development, but on a local level, and serve people rather than profit, serve their members rather than maximize profits, and help members improve their financial situation. Common services include providing a broader range of loan and savings products and at cheaper costs than most microfinance institutions. They provide savings accounts, checking accounts, credit cards, certificates of deposits, online banking, and normally only members can deposit and borrow. And here are the benefits of credit unions as compared to banks. They show significantly higher customer satisfaction rates with quality of service. Establishing an account at a credit union typically requires a smaller deposit than a regular bank, and it also buys the depositor a share in the company and full ownership. And since most credit unions participate in the co-op network, people can access ATMs without fees or surcharges, and are involved in shared branching, allowing them to perform basic transactions at no additional costs with other banks in the network. Another benefit over banks, the National Credit Union Association has discouraged American credit unions from giving members loans that they might not be able to repay, and has forbidden predatory lending and abusive credit practices. Credit unions, mutual banks, and mutual building societies have a mutual structure. They focus on community banking services that benefit their members as a first point of business rather than profit to shareholders. They don't maximize profits to pay external shareholders. They put their profits back into outstanding customer service, better products, competitive mortgage rates, and fairer competitive pricing, and fairer fees, and community focus. They typically allow anyone who has ever been a member to remain members, even if they no longer qualify, or leave the company through which they gain membership, or move outside the defined area. Each member owns the organization they belong to and have a vote in the organization's governance. But on the negative side, but arguably a plus side, credit unions can expel members who cause financial losses, but sometimes they have expelled members from making complaints against the management. So federal credit unions and some state credit unions may apply to the NCUA for low-income credit union status if a majority of their membership meet requirements to be considered low income. And if they serve low and moderate income communities, they can join the National Federation of Community Development Credit Unions, which is a trade association providing investments, technical assistance, education, training, and advocacy for member credit unions. There are a number of associations of credit unions, the NCUA, the Credit Union National Association, and other statewide, worldwide, and countrywide councils and federations and networks of credit unions, and also the co-op network, co-op financial services, which I mentioned. Credit unions typically pay higher dividend rates or interest rates on shares or deposits. They charge lower interest on loans than banks do. They have a higher cost of assets, which is interest expense as a percentage of average assets that commercial banks do. And their policies regarding interest rates are set by a volunteer board of directors, which is elected by and from the membership itself. And here are some of the drawbacks of credit unions. They can risk failure because they have to follow rules on responsible lending, which is they may not be allowed to lend enough money to people who are willing and able to repay, which is kind of the opposite problem we see on Wall Street.
Right.
So most credit unions in the U.S., this is not the case in other countries, most other countries, they emerge from an employer-based bond of association in which the bond permits the credit union to use future paychecks as collateral on loans. In 1934, the Federal Credit Union Act provided that credit unions membership be limited to groups having a common bond of occupation or association, or to groups within a well-defined neighborhood, community, or rural district. In the 80s, the Reagan administration allowed many credit unions, to grow their memberships and expand into multiple states. So that membership was restricted to employees of specific companies, trades or occupational groups, members of certain nonprofit groups, and members and their families. So those membership restrictions may serve as a detriment, being that the NCUA has the power to limit how a credit union may expand its customer base. However, the base can be widened because of family member inclusion and also mergers of small credit unions. And another drawback is that credit unions can convert to banks. And since 1995, more than 30 American credit unions have done so. And this has created controversy because the conversions are usually initiated by the credit union's leadership team rather than from the rank and file membership. And these conversions can be lucrative for credit unions executives and directors and CEOs, giving them $1 million usually, and also tens of millions of dollars plus in ownership stake. However, in at least 6 credit unions, members have organized to oppose their management's conversion proposals, saying that it comes to the detriment of members and that most members have lost their ownership stake without compensation in the process. And they also face worse rates and fees after the conversion. And another detriment is higher cost for loans and less payment for savings. So, and this is the last topic, how this relates to the 7 cooperative principles. First principle is voluntary and open membership. Membership in credit unions is voluntary, however, may be limited to certain communities, professions, and trades. But on the other hand, those memberships can expand if people move to new communities and memberships are open to families. Second principle, democratic member control. Control of credit unions is governed by members. However, the ability of credit unions to convert to banks presents a problem, as members may have their money taken without knowledge, incur other fees, with money compensating shareholders and directors and CEOs. However, members can organize to resist the conversions. Principle number 3, member economic participation. Since all cooperatives, including credit unions, which are financial cooperatives, work on the one man, one vote principle, and rather than according to the amount of capital or money invested, it's same as above. Same as the case with democratic membership control. Fourth principle, autonomy and independence. Since credit unions are in business to help members, not shareholders, like other cooperatives, if they enter into any agreement, they must do so in a way that maintains the cooperative's member control and autonomy. Fifth principle, credit unions provide education, training, and advocacy for their member credit unions, so it satisfies that principle. 6 is cooperation among cooperatives. And like I explained, credit unions do cooperate with others through national and international associations and trade associations. 7th principle, and last principle, concern for community. Community credit unions and credit unions specializing in providing financial services to low-income people do have concern for their community and their top set of purposes, aside from providing financial services to ordinary members. So with a few small exceptions to the first 2 principles, credit unions or financial cooperatives do satisfy all or nearly all of those 7 cooperative principles.
That sounds, honestly, this makes me want to open a credit union account because I don't have one right now. And it's, yeah, it sounds like it satisfies all the principles of cooperatives, like you said. And it solves most of, if not all of, the basic problems that in the last 3 episodes, we've associated with, state-owned capital or global finance capital or corporations. Because while it doesn't hinder growth, it seems to grow responsibly according to the dictates of the actual people who are affected by its growth, which seems to make it a much safer and more humane form of investment than the current model, which is, of course, big banks can collateralize your safety deposits in order to gamble and then lose all your money. So that about wraps up this episode. It was called No Finance Romance, Kopsick on Alternatives to Finance. Any closing statements, Joe? Do you want to plug your website?
Yeah, it's aquarianagrarian.blogspot.com. It's a blog on politics, anarchism, economics.
Yes, Joe is the resident anarchon.
Mm.
I like that word. All right. Well, thanks for coming.
Thank you.
You can see me, you all out there can see me playing as Bitter Ink Saturday at 6 in Charlotte, North Carolina at Repo Records on Commonwealth Avenue. Come out and see the awesomeness. It's a free show. This is the album. You can get it there. Thanks again for watching. This is Ryan O'Dowd of the Black Hand Communique saying, fuck the banks.